At 55, moving a 401k to an IRA can take a 10% exception off the table. If you leave the employer maintaining that plan during or after the year you turn 55, certain taxable distributions from the plan can avoid the federal 10% additional tax. That specific exception does not apply to IRA withdrawals. On a fully taxable $15,000 withdrawal before 59.5, assuming no other exception applies, that difference can be $1,500. That is the trap, but it is only the first calculation. The 10% applies to a taxable withdrawal. Other costs can apply to the entire account. Once both are converted to dollars, the apparent winner can change. Before comparing anything, make sure the exception is actually yours. The rule of 55 is not simply, I am 55, so my 401k is penalty-free. The separation has to happen during or after the calendar year in which you turn 55, and the relevant account is the employer plan tied to that separation. Suppose you turn 55 in December and leave that employer in March. You were 54 on your last day, but the separation occurred in the year you turned 55. Move the departure to the previous December, and reaching 55 later does not retroactively make that earlier separation qualify. The year of separation is the switch, not just the birthday. And the exception does not make a traditional pre-tax distribution tax-free. It can remove the 10% additional federal tax, while the taxable amount is still included in income. Now, the rollover becomes important. Move those traditional pre-tax dollars from the qualifying employer plan into a traditional IRA, and the specific separation at 55 exception no longer applies to withdrawals from the IRA. Other exceptions may apply under different facts, but this one does not follow the money into the IRA. So a rollover can change more than where the account sits. It can change the rules governing access before 59.5. That seems to produce an easy answer. Preserve the exception and leave the money in the 401k. But tax treatment is only one feature of the account. Plan access varies too. In Vanguard's 2025 Defined Contribution Plan data, published in its 2026 How America Saves report, 43% of plans offered ad hoc partial distributions. Those plans covered 79% of participants. Installment options were more common. 68% of plans offered them, covering 89% of participants. Both denominators matter. If you heard only 43% of plans, you might imagine partial withdrawals are unavailable to most workers in that data. They were not. Large plans were more likely to offer the feature, so 79% of participants had access. At the same time, 79% is not 100%, and the report is Vanguard's plan universe, not every 401k in America. That is not a national census, and it tells you nothing about your own plan by itself. It does establish something narrower and useful. Post-employment distribution flexibility is a plan design question. If your plan offers the partial withdrawals or installments you need, the rule of 55 may be highly practical. If it does not, the tax exception can still be valuable, but accessing exactly the amount you want may be less convenient. Vanguard makes the distinction concrete. In plans without ad hoc distributions, a terminated participant seeking to use part of the account may have to withdraw or roll over the entire balance rather than take a small partial distribution. Rollover matters there. Lack of partial withdrawals does not mean the employer forces the whole balance into taxable cash. That does not mean the rollover transaction itself automatically creates a tax bill. A properly completed rollover can generally move eligible retirement money without current income tax or the 10% additional tax. The issue comes later. If money that could have been withdrawn from the qualifying employer plan under the age 55 exception is now sitting in an IRA, a later IRA withdrawal is governed by the IRA rules. If no other exception applies, the taxable portion of that later early withdrawal can face the additional tax. That distinction matters because otherwise the title can be misunderstood. The trap is not roll over today and immediately lose 10%. It is move the account today and potentially change the tax treatment of access you need later. That correction is important because it keeps a real plan design limitation from turning into a fake tax bomb. By now, the first conclusion has already changed twice. The rollover can remove a valuable exception. Keeping the plan can preserve it. But preserving it does not tell you whether the plan gives you the access pattern you want. And even perfect access still does not settle the cost. This is where the denominator matters. The 10% additional tax is based on the taxable amount of a distribution that is actually subject to that tax. An asset-based account fee can be based on a much larger account balance. Those percentages cannot be compared honestly until they are turned into dollars. So take one deliberately simplified example. This is not a claim about typical fees, and it is not a recommendation. It is a controlled one-year model. Assume $500,000 of traditional pre-tax retirement money. Assume the former employer's 401k has an illustrative all-in annual cost of 0.60%. Assume the traditional IRA alternative has an illustrative all-in annual cost of 0.20%. For this model, apply both percentages to the $500,000 opening balance. The 401k cost line is $3,000. The IRA cost line is $1,000. Now assume $15,000 has to come out during the year. The full $15,000 is taxable and subject to the additional tax if it comes from the IRA, and no other exception applies. 10% of $15,000 is $1,500. On the two cost lines we are isolating, the IRA side is now $1,000 plus $1,500, or $2,500. The 401k side is $3,000. Under those exact assumptions, the IRA side is $500 lower, even though the withdrawal incurred the additional tax that the qualifying 401k could have avoided. Nothing mysterious happened. 10% acted on $15,000. The 0.40 percentage point fee difference acted on $500,000. That difference is $2,000. The smaller percentage acted on the larger base. Ordinary federal income tax is not being used to create that result. In this simplified pre-tax model, the same $15,000 is assumed to be taxable income on either side, so that common income tax line is excluded from the difference. State taxes are not modeled. Investment returns are not modeled. The account cost assumptions are illustrative. Change any of those facts when they are material, and they belong back in the comparison. The example proves only one thing. Avoiding a visible 10% additional tax does not automatically prove that the two cost lines we are comparing are lower. That narrowness is deliberate. It keeps the model honest. Now attack the result. Keep the same $500,000 balance and the same $15,000 in withdrawal. But reverse the cost advantage. Assume the 401k costs 0.20% and the IRA costs 0.80%. The 401k cost line falls to $1,000. The IRA cost line rises to $4,000. Add the same $1,500 additional tax, and those two modeled lines total $5,500. Now the 401k is lower by $4,500. Same age, same balance, same withdrawal, same rule of 55. Different costs, opposite result. That is why neither stay nor roll over survives as a universal rule. The first example also gives us a useful crossover. A 0 to 0.40 percentage point fee difference on a $500,000 opening balance is $2,000 in this one-year model. A 10% additional tax reaches $2,000 when the taxable amount subject to it reaches 20,000 SARs. So $20,000 is the crossover between those two specific lines under those specific assumptions. Below $20,000, the $2,000 fee difference is larger than the 10% additional tax. Above $20,000, the additional tax is larger. You can see the sensitivity without another complicated model. If the early withdrawal is 0, the age 55 exception produces no additional tax savings in that year, while the illustrative fee difference remains $2,000. If the taxable, penalty-eligible withdrawal rises to $30,000, the additional tax becomes $3,000 SARs. Add the $1,000 IRA cost line, and the narrow IRA total becomes $4,000 versus $3,000 on the 401k side. The apparent winner flips again. That is not a retirement rule. It is not a personal break-even. Change the balance, the costs, the taxable portion, the withdrawal timing, or the applicable exception, and the crossover changes. Its value is that it exposes the unit problem. The comparison is not 0% versus 10%. It is dollars versus dollars. And now the rule of 55 can be put in its proper place. Valuable, sometimes extremely valuable, but not automatically decisive. Imagine there is no need to take a distribution before 59 and a half. In that period, this particular exception may produce no realized tax savings because there is no early distribution on which to use it. But no realized savings should not be confused with no value. Access can have option value. Someone may expect not to touch the account and still care about preserving a penalty exception in case a job transition, family expense, or other liquidity need changes the plan before 59 and a half. That value is difficult to price without knowing the person's alternatives, which is exactly why the script should not quietly assign it a $0 value. The honest statement is narrower. If no qualifying early withdrawal occurs, there is no 10% tax saving to observe during that period, even though the flexibility itself may still matter. Now imagine the IRA withdrawal qualifies for a different exception. The 10% may disappear for a different reason, or change the type of money. Our example uses traditional pre-tax dollars because that makes the comparison clean. A Roth 401k, a Roth IRA, or an account containing after-tax basis can have different rules for how much of a distribution is included in gross income. The 10% additional tax is tied to the taxable amount that is actually subject to it, not automatically to every dollar leaving the account. That is why withdrawal times 10% is only valid when the model explicitly assumes the whole withdrawal is taxable and no exception applies. Then there are account features the fee example does not price. A 401k may have low institutional costs, useful services, investment options you value, or protections that matter in your situation. An IRA may have a different cost structure, different services, and different investment choices. Some of those differences are easy to put in dollars. Others are not. Creditor protection, convenience, access to a particular service, or the value of an investment option does not become irrelevant merely because it is harder to place in a spreadsheet. The fairness rule is not to invent a dollar value for them. It is to acknowledge them before a narrow numerical winner gets promoted into a universal conclusion. The SEC's rollover guidance makes the same broader point. Costs are relevant. Services are relevant. Existing account features are relevant. Investment options, penalty-free withdrawal access, required minimum distribution rules, creditor protections, and employer stock can also be relevant. Even the word cost needs discipline. A plan expense ratio, an IRA fund expense ratio, an advisory fee, a record-keeping charge, and transaction costs are not interchangeable labels. If one side gets an all-in number and the other gets only a fund expense ratio, the comparison has already been tilted. The illustration works only because we define both 0.60% and 0.20% as comparable all-in annual cost assumptions. That is not a reason to make the analysis vague. It is a reason to stop pretending that one fee calculation produces a personal recommendation. The fee example isolates a mechanism. The rule of 55 isolates another. A real decision can contain both. There is also a timing issue in the model itself. We used a one-year comparison and applied the fee percentages to the opening balance because that makes the arithmetic reproducible. If money leaves early in the year, average balances can differ. Over several years, recurring cost differences can accumulate. Those refinements can matter, but pretending to calculate them without the viewer's actual balances, withdrawal schedule, account costs, and investment choices would create precision we do not have. The point of the crossover is therefore not to hand someone a magic number. It is to prove that the visible 10% can be larger or smaller than another cost line depending on the dollar base, and then to show that the answer reverses when the inputs reverse. There is one more claim that needs careful wording. Moving money to an IRA is not necessarily a permanent, irreversible one-way door in every respect. The IRS allows otherwise taxable amounts from a traditional IRA to be rolled into a qualified employer plan if that receiving plan accepts the rollover and the other requirements are satisfied. But that does not automatically recreate the original Rule of 55 situation. The age 55 exception depends on a qualifying separation from the employer connected to the plan from which the distribution is made. Moving dollars into another plan later does not retroactively change when or where the earlier separation happened. So the useful lesson is narrower. Moving retirement money can change which distribution rules apply to it, and that should be understood before relying on a particular exception for future cash needs. Now, the title can be stated precisely. At 55, the hidden 10% trap is not a secret charge buried inside your 401k. It is the possibility that a qualifying employer plan has an early distribution exception that an IRA does not have. Move the money first, need cash later, and the tax treatment of that later withdrawal can be different. That is the first payoff. The second is why the episode cannot end there. 10% is emotionally loud because it is easy to see. A fee difference of a few tenths of a percentage point looks small beside it, but the two percentages may be acting on radically different dollar amounts. That is why the useful question is not simply, how do I avoid 10%? It is, 10% of what compared with what other costs? Under which rules? And even that question still needs the facts of the account. Was the separation during or after the calendar year you turned 55? Is this the employer plan tied to that qualifying separation? Will you actually need access before 59 and a half? Are the dollars traditional pre-tax Roth or after-tax? What distributions does the specific plan permit? What are the genuinely comparable costs and features on both sides? And does another exception change the tax treatment anyway? Those questions do not produce a universal winner, which is exactly why they are more useful than one. There is a behavioral reason to keep the sequence this way, although it does not require pretending psychology proves anyone's decision. 10% is a loud number. It is easy to picture $1,500 disappearing from a $15,000 withdrawal. A few tenths of a percentage point can feel trivial by comparison until the balance is large enough to translate that small rate into thousands of dollars. The math forces both numbers onto the same unit before either one gets to dominate the decision. A blanket, avoid the 10% rule, ignores the rest of the account. A blanket, Keep the 401k rule ignores situations in which its costs or features are less attractive. Its blanket roll it over rule can ignore a valuable access exception. The math only works when the assumptions are allowed to fight back. In the first cost example, the lower-cost IRA overcame a $1,500 additional tax on the two lines we modeled. In the second, the cheaper 401k won by $4,500. Neither result contradicted the other. The inputs changed, so the answer changed. That is the real protection against the trap. Not fear of the 10%, not loyalty to a particular account label. It is knowing which rule you actually have, whether you will use it, what your specific plan allows, and what every percentage is being applied to. At 55, the costly mistake is not automatically staying in a 401k, and it is not automatically rolling one into an IRA. It is making the move before you know which equation you are actually solving.